right, so we're here at the Real Estate Roundtable with IPRG, and today we have some guests. We have Robbie Ferman and Jake Movsovitz. Did I say that right?
Yeah.
All right, perfect.
Yeah.
From Sollevare. Did I say that right?
Oh, well,
Just some out.
So how do you pronounce
Sollevare.
Sollevare.
Yeah.
All right.
How did that name come up?
Welcome, guys.
Yeah, well,
Thank you.
And real quick, Luke Sproviero is here.
Of course.
This is Derek Bestreich. So happy to have you guys in. Known Robbie for quite some time, and Jake, good meeting you earlier today.
And so got my pre-wed and then worked at Wells Fargo doing a construction lending internship, but really learned a lot when I moved to Atlanta. And I worked in Atlanta for a little over a year doing real estate private equity, and then I moved to New York City and worked at Blackstone for 3 years, which was a phenomenal experience. And we met about 2 years ago, which we can get into. And sort of how we came to where we are today, but always wanted to do real estate. And so I took some classes on real estate.
did that
I
early
learned a lot more just doing it.
Yeah. So you early on in college, you wanted to be in real estate. Mm-hmm. Yeah.
And then how'd you get started, Robbie? I obviously know, but I'd like to hear you say it.
Yeah, I didn't really have much direction coming out of college. My dad was in real estate, but he's more on the residential side, so I wanted to do something a little bit more stimulating, and I felt like commercial would be better for that. So I got a job coming out of school as an analyst at JLL, and then I also got a job at Marcus. I felt like the eat what you kill, meritocracy, more fit what my skill set could be, and I was extremely hungry. Something Jake and I talk a lot about is that we both didn't necessarily go to target schools, so we have always kind of had a chip on our shoulder a little bit. And so, started at Marcus and was I'm just going to outwork everyone. And I thought I was going to be smarter than everyone. And so I was like, this will be a good fit from what I think I'll be successful in.
No, that's great. Obviously, Derek and I and a bunch of guys here started at Marcus, so we know exactly what you're talking about. And I think, definitely my feeling when I started, that was a big piece for me. Make as much as you want, no ceiling. Obviously, the same, similar thing with the college. And I wanted to definitely prove stuff and outwork the people in that office.
Yeah.
And from what I hear, we're still pretty popular over there. People discuss us. We're 10 years later.
I don't know. Yeah, I could imagine, but I don't know.
All right.
Yeah. Talk to you guys all the time.
Good.
Yeah, that's great. Yeah, Marcus is a good place to start, and then you went over to Newmark, and then you left to go start buying buildings, and you guys have you have some money, and you've been buying. So yeah, I mean, I guess if maybe you want to talk about your transition from out of brokerage.
Yeah, absolutely. I think a good place to start would be how Jake and I got connected and why we thought we were going to form a great partnership. So our best friends went to college together, and as we graduated and all moved to New York City, the friend groups kind of merged a little bit, and our mutual close friend, Chris Howard, was like, you guys are on very similar paths, share similar ambitions. You guys should absolutely get dinner, meet, and just see where it takes you. Mm-hmm. And so Jake and I went to some Greek restaurant, and we kind of hit it off. And for 5 years, I always knew I wanted to eventually start my own business and do something more on the acquisition side. And it was just a matter of finding the right person who complemented my skill set. But most importantly, and the biggest prerequisite for both of us, was finding a person who shared similar values to us.
Yeah. I mean, it's funny, you guys probably get this, you work in real estate, and then somebody that doesn't work in real estate, it's oh, you should meet so-and-so. And it's it's totally not what you do in real estate. So when Chris connected us, I knew we had some overlap, but what, you know what I mean? I was didn't think much of it, but I heard good things about him. He's a great guy. And just trustworthy, honest, whatever, all the checkbox items, but I didn't think much of it. And then we sat down, to this point, can immediately tell from a value standpoint, the way he talked and talks about his girlfriend, the way he talks about his family, resonated with me. And then the more we talk and we realized we have very similar ambitions and view the world pretty similarly. Also in the target school note, we also kind of got some stuff out of our system early, you know, like we had great times in high school, great times in college, and like now we're just
we're very high.
I don't need to be caught up in the hoopla in New York City. Like we're very, very focused on what we want to do and what we want to build, and like that is our priority.
What is that? What you guys want to do? What you want to build? What are you guys locked in on?
Yeah, so I guess as we continue to meet and continue to like form our thesis, like we also realized we have very complementary skill sets, and so as we were building that, we were building our thesis based on our professional experience. And like first and foremost, what we both agree on is like we want to buy stuff that we actually want to own. Like we don't get caught up in like phantom exit cap rates or like solving to the highest yield just because it makes sense in a model. Like we want to own stuff that we are proud of owning and like assembling kind of a prime portfolio, which is something we both agreed on and had seen sponsors go wrong where like they're buying something, they're reliant on some exit cap rate that might make sense at the time or might have made sense 3 years ago but doesn't make sense in today's environment, or the entire deal hinges on that exit, where like we wanted to avoid that. And then some of the stuff too, that's not always the nicest stuff. Like you were young, so we haven't lived through many cycles, but like I worked on, I just like at Blackstone, I was in the secondaries group, so I got to see what a lot of underlying GPs were up to, and like you see how they bought in 2021 at such inflated values, the deal only made sense at a certain exit cap rate, and they over levered, and now they're underwater. So like we wanted to avoid that as well. And then based on our background, his background in brokerage, my time as being an institutional exit in these markets, like we're super exit focused. Like what will be the cleanest exit one day to an institution? And so we kind of worked back from that.
That's where our huge competitive advantage is that like I had transacted on 40 plus buildings in these types of neighborhoods and had real practical experience of understanding what does the buyer pool value, and like it's just so much more nuanced than slapping an exit cap rate just because the locations are similar or whatever it is. And then Jake, as he mentioned, being the actual exit at an institution and looking at various portfolios in New York City and around the country, like that's how we started to shape our thesis, which we can get into as well.
Can you dig in a little bit in terms of when you say like these locations and like these types of like asset types, or like what the assets are that like that you think the institutions or would like to buy or where you could exit? Like what does that look like?
Yeah, it's a really good question. So a building on the same block in New York City, one, as you guys know, could be worth $2 million, and the same exact building with the same footprint, with the same layouts, could be worth $5 million because of rent stabilization. But the key difference also is when you're underwriting those deals, when you're exiting that real estate, the cap rate that you're going to exit at could be widely different as well. So like you buy a building at $2 million and you can't just say like the $5 million and the $2 million building because one was a sub-rehab or one has partial rent stabilization or imperfect paperwork is going to have the same or even a very similar exit cap rate. Like they can be completely different. And when we think about packaging up our buildings down the line, we're very conscientious of like, how are we going to deliver like our portfolio or whatever it is in the most deliverable fashion, for lack of a better way to put it. And
100%.
Yeah, that means like, everything that we're buying has to be absolutely pristine.
It's a good point. I mean, I completely agree with what you said in terms of buying what you want to buy, buying what you want to own. We're seeing that from a broker standpoint a ton of funds and raise capital that still own some things prior to like call it COVID. They would never own that or buy that today. So I think prices got super inflated in 18, 19, and people were buying in tertiary areas, the areas that they probably are not focusing on today, and now they're stuck owning it, and it's definitely a harder exit. So I think if you could avoid that and just buy, I know the areas you're buying in that stuff, and just keep it solid, no matter if you think the exit could be higher somewhere else, it's a winning way to do it for sure. There's a lot of issues now with that stuff.
We're hyper focused on like these Brownstone Brooklyn neighborhoods. One, that's where we have a competitive advantage. So like Robbie's background in brokerage, we have a competitive advantage from a sourcing side. Just you can walk down the street with Robbie, like we did it when early on as we were thinking about forming Sollevare, and that was when I was like I knew he knew his stuff, or I don't know if in Gus he knew shit.
Yeah.
But as we were walking these neighborhoods, like he could literally point at a building and be like, so and so owns it. That retail tenant's paying X, Y, and Z. Like they just renovated the bedrooms and they were getting this. Now they're getting this. Like down to like a block by block knowledge. It started raining. He was like, oh, there's 2 coffee shops up on this corner. We hopped into one. We waited it out. So he just knows every owner in these markets, and that allows us to just have a huge advantage when we're sourcing, because the deals we've done to date, we source truly off market, and so you're buying at a more attractive entry basis. You're avoiding a broker fee, and it just it's just a better deal on the buy side. And then these neighborhoods also happen to have extremely compelling demographic trends, which we can also get into. But
I'm going to cut you off for a second, and the stuff that we're looking at is not even like mostly off market. Like I would say a lot of it is due to our previous relationships in business, but like a lot of like the best deals that we're finding are also broker deals. I'm not just saying this because you guys are brokers. There's a lot of deals that slip through the cracks for various reasons. So like I always think about the scene from Moneyball, where they were like sitting in a conference room, and I think it was Jonah Hill was like, the most important thing when you're looking at how to evaluate like putting together the best team is like, what is someone's on base percentage? And so many people look at things about a player, which I'm kind of butchering this, but
opinion that runs and stuff,
right? Or like they have some type of defect that automatically someone writes off, and then like we kind of take the same approach when we're looking at buildings and looking at marketed deals. Like sometimes an institutional owner is selling an asset, and you're thinking to yourself, why would like a Brookfield ever sell this type of assets? There must be something wrong or something that we're not missing. And then if everyone takes that herd mentality and approach to thinking about that deal, then no one's going to buy it and the price is going to slip down. And so like there are a lot of opportunities and stuff like that that we're looking at as well.
No, for sure. And you make a point with the brokerage. Obviously, like getting a direct deal, depending on obviously the price, it could be a very good opportunity. But I think the reason why we get so many deals done, we have a lot of relationships. Same thing with you guys, ton of relationships. So every broker has their own relationships with these long-term owners in these markets. So that's who's going to get hired. And obviously, the broker that has those relationships probably would have some control, but for sure. 100%.
And every seller is different. Like one seller might have to just sell super quickly for whatever various personal reason is happening. And like a broker who knows there's a buyer who can actually purchase a building and move quickly, like is going to get a much better deal than someone who like will only look or like won't look at a broker deal. Like I just think that's such a ridiculous mentality. And when I was brokering deals, I heard that all the time. Like I would never buy a deal that you're selling. And I was like, that's so crazy as me.
I think it's not every case, obviously, but sometimes people overpay off market. You don't have a sense, right? You're like, oh, it's a mom and pop and it's off market. No one's I'll pay the price, but brokered deal's been out there. People look at it. It's like, it's probably the price could come down a little bit. People don't necessarily want to look at it. So I think you can buy better deals on market sometimes. Obviously, it's completely situational.
A deal that we bought not too long ago was on the market for $4.5 million.
Yeah.
And the price just kept dropping, and like we stayed on it. And the broker called me. He's like, I can deliver this at $3.5 million. And we're like, oh my God, like this is a great deal.
Yeah.
And we negotiated down to $3 million, and we bought it for $3 million. And then once we went under contract, everyone called us and was like, will you flip us this building? Like we'll pay you a profit, like hundreds of thousands of dollars to flip us the building. And it was just marketed. Anyone could have bought it at the price.
They forgot about that.
Yeah, they forgot about it.
Time is not good. You're going to forget, and timing's everything, right? You talk to the broker at the right time and seller's ready to transact, and all those other people forgot.
Exactly.
It's good. It's a good opportunity.
Yeah. But and I cut you off, but like we do want to talk about what our investment thesis is because we think it's pretty compelling and we have so much conviction in what we're doing, and I think that has led to our ability to raise a lot of money around this.
Okay.
Yeah, we'd love to hear more about it.
Yeah.
Yeah. So historically, and in the baby boomer generation, their family's peak spending power was at age 55. That's because they were single income households That's when the male earned the most money. And they were having on average 2.5 kids. So they needed more space. They didn't need to be as close to work because one parent was working. And so that led to people moving to New Jersey, moving to Long Island, more like real suburban areas.
Mm-hmm.
Nowadays, millennials are having on average 1.5 kids, and they're dual income earning households. So their max spending power is at age 35 instead of age 55. And since both parents are working, they need to be close for work. But they don't want to be in Manhattan. They'd rather be in lower density zoning. And also the schools in the areas that we're buying are phenomenal. And so the perfect middle ground are these Brownstone Brooklyn neighborhoods, because very close proximity to Manhattan where people work, but you also get that suburban feel, and it's lower density areas, and it's just a higher quality of life. And so what we're seeing is a flood of demand in these Brownstone Brooklyn neighborhoods, but there's way more demand than there is supply, particularly in 2 and 3 bedroom apartments that suits the actual needs of these younger families. And also the townhome market, as you guys probably know, has absolutely skyrocketed.
Yeah, you guys have talked about it on your podcast.
Yeah.
You can't really
buy a business right
you can't
now.
buy a townhome for less than like $6 million in these neighborhoods. And so there's still very affluent young families that want to live in these neighborhoods, but like can't afford a $6 million townhome. And so what do? They need to rent a 2 or 3 bedroom apartment, but there's just no supply. And so part of our thesis is buying buildings with larger floor plates where we can convert the units into 2 or 3 bedroom apartments and really meet and alleviate some of the supply and demand imbalance.
Apartments with actual living space, they have a table, things like that. No, for sure.
Exactly.
And we think it's great tenants too, because their kids will go to the public school.
Yeah.
They're very sticky, and they can kind of age in place in our buildings. Whereas a lot of New York City sponsors target like the roommate situation, because you can squeeze 4 bedrooms, whatever, into a floor plan and fill them up, but there's a lot more turnover.
Correct.
Do you guys have a sense of like young families moving to Brooklyn? Like that trend was like there's a lot of young families moving to Brooklyn like 10 years ago, and I was part of that, so I saw that firsthand. But I'm wondering, and I'm 42, but I'm wondering for the people that are maybe like 10 years younger than me or like 7 years younger than me that are just like starting to get married, are they moving to Brooklyn? Are they looking to start families in Brooklyn, or are they looking to move elsewhere? Do you guys have a feel for that?
Yeah, Brooklyn is pretty segmented. So Williamsburg and Greenpoint are the guys or the people who are probably like 5 or 6 years out of college and are single or like in a relationship, and that's where they're typically moving. But the younger families are moving to these Brownstone Brooklyn neighborhoods, and they want to grow families in these neighborhoods. And as Jake said, millennial families are not having as many kids as the baby boomer generation families are. So like they can stick around in these neighborhoods, and they don't need more space than what Cobble Hill, Brooklyn Heights can supply.
2 to 3 bedrooms.
The issue is there's just no rental product out there for that
Zero.
type of stuff. And so that is our thesis.
Renovated 2 and 3 bedrooms, like washer dryers, like
We're just supplying the demand that's out there.
units that families can live in.
Units that families can live in and maybe even grow in a little bit.
Yeah, they treat the apartments better than 4 single dudes that would.
Definitely.
Exactly. And something interesting.
Sorry, but the kids, right? Like I live in Tribeca, I have a big space, and I have 2 kids, but I will say I'm a little nervous. I mean, the kids mess things up. I'm like, when I was in an apartment with my friends, we were like treat things very nicely. Every time I turn around, there's a marker on the wall. They're writing things, whatever. So yes, I agree. It's kind of a joke, but the kids, they do mess.
We also talked about this with that
your kids too.
that building in Greenpoint, where we were talking about if people leave these apartments, say that they got, they were told they had to leave or whatever, the rent got raised. You said they're not staying in New York. Like you said yesterday that they're out of here. They're going to move to New Jersey. They're going to move to Westchester.
Well, it's just the space, right? And
I guess the point I'm trying to make is these people probably will stay. Like they might be hard. The kids might be hard on the apartments, but there's a lot of demand, and these people are going to stay for
I will speak
2 to 5 years. They're not going to be turning over every year.
Very sticky den.
I have a 4-year-old and a 2-year-old, and we're obviously staying in the city for a little bit of a longer term. I have a big space now, and if I could have the kids grow up in there, which I'm assuming I can, we'll see after kindergarten, 1st grade, 2nd grade, 3rd grade, I would say. But yeah, the space is a hindrance, and like a big apartment in New York, like let's say 1,800 to 2,000 feet. That's a big apartment. That's not big compared to like outside of Manhattan, right? It's a very small space to live. So yeah, it's definitely a scary thing.
So is it safe to say that you guys are not looking in Williamsburg and Greenpoint based on the demographic you just described?
Correct. We are not looking there for one of our two strategies. So that was the first strategy that we talked about.
Okay.
We have another strategy that we are pretty bullish on, more based on the macroeconomic trends that are happening right now, and like with where tariffs could be going. We want to buy existing larger buildings like 421A buildings. And there are two main reasons for that. One is if you think about how tariffs affect real estate, it's going to cause the cost of construction to go way up.
Mm-hmm.
So just like on a very high level, existing real estate is going to be worth more money. And then two, there was a long delay in the new 421A program going to 485X. And so the pipeline of new construction is way down in New York City. So we like those supply and demand also trends that are happening towards like buying these newer construction buildings that are trading at big discounts compared to historical norms in New York City.
But that business plan, like I've heard, does that contradict like the space thing? Because a lot of these new construction buildings, right, like they're cookie cutter, they're built to be efficient, right? Every piece of square footage is used, and a lot of times the living area and the bedrooms are a little smaller. Do you think like the whole pre-war aspect is kind of gone at that point where you have living space? Are you seeing that at all or not really?
Those buildings don't really exist very much in the Brownstone Brooklyn neighborhoods that we're looking at. And so when we're looking at Greenpoint and Williamsburg, we also obviously love the supply and demand dynamics that are happening there. We would look at those types of buildings just because we think that those yields are trading at much better rates than what they historically have.
Gotcha. So that's like a thing for Williamsburg Greenpoint.
Yeah.
Got it. But not like the Brownstone more bare.
Yeah, like if we're raising on a deal by deal basis, that would just be like a different bucket of capital. Yeah, it's not like two separate funds. We would obviously think about those deals differently. That would be more of a traditional real estate PE business plan. Yeah, is what we're buying now. Sometimes we're even thinking about it as like, how can we hold this forever? Like this is such timeless classic real estate. How can we hold this forever? Whereas for those assets, it would be probably a little bit more of a traditional 4 to 6 year hold period.
Makes sense. So these assets that you just described, these two buckets of capital you have, these are what you guys would consider to be pristine assets?
So anything that is statutorily free market, we think of as like pristine. But when we talk about the portfolio we want to deliver to an institution, these would obviously trade differently or be thought about differently by an institution. So like on the one hand, and I would say probably where we're spending most of our time, are these timeless walk-up assets in these brownstone neighborhoods. That I'm thinking about as like one portfolio, and then the 421A product, I think we'd like to probably do 1 or 2 of those a year once we're really up and running, because it's just a way to deploy more capital. In those deals with the proper riders are also statutorily free market. And so that's why they fit our broader thesis of what we want to buy, but it's still two separate strategies.
What about J51 properties? Would you guys look at those?
Yeah, absolutely.
Okay.
Yeah, as long as we kind of got into the weeds on these J51 properties. J51, because we're looking at a few of them right now.
Yeah. So what are the weeds on those?
If it was like a factory, then like we just got some pretty good LT. But
factories.
Yeah, and it was converted to a multifamily that, even without the proper riders, will likely, it seems to be pretty black and white that will be free market out.
What if it was an apartment building?
If it was like more than 5 units, it's much more gray. And that's probably something we would stay away from, especially because we're very focused on building our brand and our reputation too. And so we don't want to take any risks in that department.
How do you guys underwrite the because obviously 420A and J51s have tax exemptions and abatements, so the taxes are like artificially low for the time being. How do you guys underwrite the tax increase exposure on that stuff?
Using a discount rate. Jake is the underwriting expert.
Yeah, we just think about the abatements separately.
Yeah.
So you just apply a different, in that case, discount rate to the abatement, and then you would value the rest of the real estate, how do you normally win on like a cap rate basis?
I like it.
So I don't know if you guys want to discuss this, but I noticed these last few deals that you bought were all cash. Is that something that you're always going to do on these smaller, like Brownstone type deals? Call it the 2-over-1s, 3-over-1s, the 4 families, that type of stuff.
Yeah.
I think it's a huge thing. Most people don't do that, and I love that. I think it really makes you flexible and nimble. And
it goes to what our overall business plan is, and absolutely, that is what we're going to continue to do. It's much more difficult to do on the purchase, but then it makes the rest of the ownership process significantly easier. And we also think it's what's best for the real estate overall. So when most people are scrambling to get a deal done or buy real estate, they're doing things that aren't in the best interest of the returns of the building, and thus not in the best interest of their investors. And so when we're thinking about it, the buildings that we're buying are either very low yielding deals or they're non-existent yields. So if you're taking a bridge loan and you're paying 9, 10, 11% in interest, that's just coming out of your own pocket.
yeah,
And so we luckily are in a position that we have the capital to deploy to buy these things in cash. We're going to go do the work that we need to do to stabilize the building, get it to as close as possible, or beat our underwriting projections, and then refinance everything and boost our cash on cash returns.
Yeah,
That's the way we're de-risking the deals, obviously, as well.
And like if we are getting to the unlevered yields that we think we will, it gives us a lot of flexibility, right? Like if capital markets aren't where we think they're going to be in 3 years, if we're still getting to an attractive unlevered yield, it's like, all right, we can just keep clipping this yield until capital markets are where we want them to be. And then once we take out a loan and we can get to like the mid to high teens cash on cash returns that we think we're going to get to, then we can be very flexible when we exit, because it's like, all right, capital markets aren't where we want them to be. We aren't reliant on this 5% exit cap rate in year 5, or else our whole model busts. We can just keep flipping a 20% return on our equity remaining in the deal and wait for capital markets to be where we want them to be, and then sell if we want to do so. So it just gives us like a lot more flexibility, and to Rob's point, just do what's like best for the real estate and what's best for our investors.
Yeah. These are value add properties as well that you guys are looking for, right? You're looking to build to a certain yield, or would you buy something that's like turnkey and finished product? Like
We're basis buyers.
basis.
Yeah.
yeah.
So you're looking for like what, a price per foot?
Because it's statutorily free market, that is the first thing that we look at in a deal, is what's the price per foot, because we know how to create enough value in these buildings that, like, if we're buying sub a certain price per foot, we know the building is going to return a good enough yield to purchase it. So like that is number one. That is the first thing that we're looking at when we're analyzing a deal.
Mm. Listen, I love that business plan. I think buying cash opens you up for a lot. Obviously, a lot of people need financing to buy, and if you're coming in all cash, especially today where financing is very difficult, I think that's, even from a broker standpoint, that's very attractive for us to want to go to someone like that rather than with the whole honor about 90, 120 day. Like, it's not contingent on financing, but you know they're going to go for financing, and you know it's going to be a headache.
Right.
And yeah, from obviously we own buildings as well, and from a construction standpoint, doing construction and doing that stuff in cash without having that bridge loan or that hard money loan, it just makes it so much better, and you make way better decisions, and you don't have some massive gun to your head. So
Exactly.
I think that what was just described is how it's done.
Mm-hmm.
If you can, obviously, you have to have the equity.
We're very young, so like we understand that there are a lot of things that we don't know, but something that we both have seen is where have people gone wrong in like our shoes before us, and every single time that someone has over leveraged the real estate, and then the markets change, and then you're stuck in a bad position.
What are the 3 L's?
What's leverage, ladies, and what else? Liquor, ladies, leverage. That's it.
3 L's that will kill a man.
That'll kill a man. Leverage and ladies.
Ladies, there we go. And liquor, obviously.
Corporate that into a pitch now, so
3 L's.
we don't do any of those things except.
Yeah.
I think it's Charlie Munger quote.
I mean, it probably is.
Yeah.
When he takes you out.
Exactly.
Takes you out. It has the possibility of taking you out. And and all three, people that had all three.
Oh man, the leverage though, we've seen it kill people time and time again.
Yeah.
I mean, everyone knows that. I mean, it's so important. Things change, right? Like we saw, like when I was a broker, when I started being a broker, my dad's a physician. He was like, Luke, like be careful. Rates are so low, and like you don't think about it, right?
Right.
Like 3.5%, like that was just so low, and we all saw what happens when those tick up, and it just shows you how the whole commercial estate market's built up on these rates, and they can go up, they can go down, they can do whatever they want, and if you're holding a potato at the wrong time, you're done.
That's another thing that's pretty interesting that we felt a lot about too, is everyone tends to think about it like as interest rates go up, real estate values kind of go down. But I don't know if that's necessarily the case, and like something that we're very bullish on in the environment right now too, and another reason why like buying cash is such a competitive advantage is that it's really about the liquidity in the market. Rates could be as high as they want, but if people have a lot of cash, then it's going to create more competition and it's going to drive prices up. Mm-hmm. And banks are just not really lending at all right now, and there's very little liquidity in the market. Yeah, and so that is part of the reason why cap rates are so elevated in today's environment, and why we are so incredibly bullish on buying New York City right now, because you can buy a New York City cap rate at over 6%. I'm sure you guys are selling a ton of deals like that for sure, and you can't buy it anywhere else in the country.
But even we had our Jersey team in here today, and the cap rates in Hudson County across the river they don't have the same rent laws, so you can obviously it's different. Right. They like are selling 4 caps, 5 caps. I'm from Connecticut. You can't buy in like Bridgeport, Connecticut for a 6, 7 cap.
So we think
it's insane.
Even without any competitive advantage, we think any real estate that's being bought today is going to be a great investment in the future.
Yeah.
Awesome. I mean, so every time to buy.
I've worked in every market. Yeah. When I was at Blackstone and before I was at Artemis, and like New York City just has the best operating fundamentals in the country by far. Like when rates went up and whatever, we've had the credit crunch, etc. Like the operating fundamentals in Austin, Phoenix, Atlanta, like they fall off. Like rents are down year over year in these markets. Occupancy falls to like low 90s, high 80s. Like that just doesn't happen in New York City. Right. So like, yes, there's a backdrop of rent regulation and the potential for legislation that's unfavorable to real estate in New York City, but like there's not like the drop off in rents or the drop off in occupancy that you can get burned on in some of these cities where there's just been so much liquidity flooding into.
You know, someone just fall in love with the real estate. It's like a 2-over-1 on core, right? Like someone's they know how prime it is. They're gonna want to own a piece of that. Yeah. And these other markets are so yield driven where interest rates go up or insurance goes up, taxes. And it's like, oh, well, now I'm at a 7 cap, right? Whereas New York, there's value protection. People want to be here. They want to own here. They want that prime retail piece on Cord or Smith.
Right.
It just works.
And so I lived in Midtown Atlanta for a year after college, and like all that stuff, it pops up and it has value for like a year or two, and then 3 of them pop up next to it, and that one is now like the old, it's not like all of the value is like in how new it is, and like I don't know, like what we're buying is just timeless.
It doesn't become outdated. Yeah. All the stuff, all that product that Jake was just talking about just becomes outdated, and then it's not desirable.
New build on Piedmont Park.
Right? The supply constraints are what's really interesting. You know, with the rent regulation laws, like obviously that was bad for people that have rent stabilized units, but for people that have deregulated free market units, it's been unbelievable because the amount of demand and rent growth in the free market category of the market has been
it's like 8%. It's been 13% year-over-year rent growth since 2019, and then 8% year over year if you like COVID adjusted.
Like for maxed out rents. Yeah. So like literally in these markets, year over year rent growth is 13% since COVID, and that's a little skewed because of COVID. Yeah. And even last year, over 8% on maxed out rents.
And we underwrite 3 or 4% in our model, and just to make sure it makes sense. But
that's a big increase though to put on a tenant.
Yeah.
You know, like someone's paying like $5,000 and to put like, you know, an 8% or 10% rent increase on them. Like, it's a big number.
Oh, 100%. I wouldn't say we are sitting here saying we want to squeeze our tenants for every.
Of course not.
And in our model, we're underwriting 3 to 4% annually, which is a nice, like, you don't see that in other markets. It's like they kind of have the pop for a year, and then the next year it cools off. Like now I've heard Milwaukee is seeing like insane rent growth, but it just in these markets, it's like the Southeast and then the Midwest, and then it oscillates, whereas New York City just keeps humming.
Yeah, and you guys keep saying towns. I love that. I mean, we just sold a building in Carroll Gardens, and I think, especially from like an Italian standpoint, it's an old Italian neighborhood. That's just such an incredible place. Oh, third place. And we were in there. We were at the closing, and it was the same family owned it forever. They, someone that lived on the block just had to be there buying it, paid a nice number for it. And we're taking the wine. They're taking the winemaker that was out of the basement that the guy had in there since who knows, the 60s, the 70s, whatever it was. And they're like, oh no, leave it. That thing is sick. Like I'll keep it. And like these people just love that.
Yeah.
Think about like
prime the
16 Court Street, like
Cruise
Curb Appeal, like.
Carroll Gardens is obviously I love Brooklyn Heights, I love Cobble Hill, but Carroll Gardens has a special thing. It's a really sick neighborhood.
Most people pay for the new thing, but those neighborhoods, people pay for like the original moldings and all the original details in the buildings, and that's just stuff you can't recreate.
Not for sure. And they have the gardens in the front.
It's a very well built.
For sure.
Buildings are well built, 100%.
Yeah.
It's brick.
And I still think there's a lot of, obviously there's upside in Brooklyn, but Carroll Gardens still is a little bit of ways to go, and it's definitely there, right? Like you walk down Court in those areas, I mean, there's still some good upside. I think there's some really good value in Carroll Gardens. Cobble Hill's starting to get really hot. Obviously Brooklyn Heights.
What's like
tough.
What's like the worst location that you guys would buy for this business plan? These statutorily free market, like built for families, like. Would you go like are there neighborhoods kind of on the fringe of that you'd consider?
I wouldn't say any. When you say worse, they're not bad neighborhoods. Like all the neighborhoods that we're looking at are great. Like we're super bullish on certain pockets of Gowanus.
Yeah.
We should go right over the highway. Like
would you go across the highway into like Greenwood Heights or Windsor Terrace, or
if it was the right deal, but probably not as aggressive.
Okay, so you're looking for like primer stuff.
Yeah.
Mm-hmm. And your price per foot stuff, obviously, if you don't want to get into it too much, but I'm assuming like under 700, 600, something like that, right?
Under 800, and it depends on the location. Like we're looking at a deal actually off market from an old relationship of ours that we just did over $900 a foot. But it just
really building, I think, for $900 a foot, but it had a cell tower, so that might be a little different.
Ah, the cell tower.
Cell tower.
We sold it off.
We heard that you have sold a great background in cell towers.
Yeah, that was my first line of work when I moved to the city. Is cell tower lease buyouts.
I told him that's how you bought your Brownstone Park Slope.
It's true.
Cell tower.
True. I bought a cell tower in 2009, great financial crisis, and it was a good deal, and I cash flowed it for like 10 years, and I sold it, and it basically allowed me to buy a brownstone.
That's awesome.
Yeah, it was cool.
Did you sell it, guy?
Yeah, so
you sell it as part of the acquisition?
We got to give credit to Jake here because we've just seen so many deals. Like, although we're young, I would say we're old in terms of how much deal volume that we've seen combined. And Jake had experience at Blackstone cell towers, and immediately when we were looking at this deal, he's like, "There's tremendous value in this," and Jake can get more into it. But yeah,
I mean, we closed a portfolio 2 weeks ago today, and one of the buildings had a cell tower on the roof.
Yeah.
And we bought that deal pretty off market, so there wasn't a lot of eyes on the portfolio. Mm-hmm. But immediately, like, I'm sure you know this, like if it's leased to the right tenant, there's a near-term expiration on the lease. There's oftentimes more value if the lease is below market. And so immediately I was like, all right, we could get a pretty good amount of money for this cell tower lease. And so Rob took it to a bunch of
cell towers are super misunderstood.
They're extremely liquid, and they
are
ridiculously liquid.
They trade for very low prices.
And even more arbitrage for them right now. Yeah. Because if you think about it, right, like if apartment was trading, let's use New York City. There's a prime apartment trading for 4.5% cap rate, and the cell tower is trading for around that, maybe closer to a 5% cap rate 3 years ago. then you think about relative value today, where the cell tower is still trading for that same cap rate, but the apartment and retail product is trading for a lot wider. Then like, I almost feel like we just sold off the cell tower too at a really opportune time, because you think about relative value.
You mind asking who bought it? Forgot who you sold it to?
I think we have an NDA, so let's just err on the side of caution.
It's our institutional tower.
Yeah.
You sold
Institutional.
But they're super misunderstood, because people assume when you're selling
Real
a
tenants.
cell tower, it's T-Mobile.
It's T-Mobile.
Yeah, that you're giving up the rights to your roof, but really you're just giving up the rights to collect the rent, and that's it.
Well, it's usually an easement.
Yeah.
It's an easement, but the lease already has an easement.
The lease already is the easement.
There's
So you're
already
not
an
giving
easement,
up
yeah.
more rights. When
No,
you
there's
sell
no
the
additional
cell
right.
tower.
There's the same right.
Didn't you have to like extend your lease a lot though? You did some things to get more money. I remember.
Yeah, I mean, it's kind of a long story.
Yeah.
But I took a specific easement when I bought it. So I
Yeah.
just took an easement to the specific rooftop location of the cell tower. But then I realized there's more value in having a general easement, which is the entire rooftop, because that gives you the right to collect rent from any future carriers that go to the roof.
That's what we
And when I bought it originally, so I bought a 30-year specific easement or maybe it was a 40-year. But I owned it for long enough that it started to dip below 30 years. And under 30 years, I forget the exact term, but it's not considered like if the lease is over 30 years, it's considered a real property interest that you can do a 1031 exchange on.
Got it.
But if it goes under 30 years, so my interest was like less. Like today, I went to 29 years. I think I did not have the real property interest. So I couldn't do a 1031 exchange. So I went back to them. I gave them more money, and I bought the rest of the roof, and I extended to 99 years. And then at that point, and I also got an SNDA from the lender, which was HPD on that property. It's pretty good, which was very hard to get.
Yeah.
But they want to have SNDAs because, I guess, if the property is ever sold and the bank gets into like the first lien position, and all of a sudden whoever bought the cell tower could be in like a second lien position, where like the bank could say that like that revenue belongs to them. So if you get the bank to acknowledge that the lease has been sold and that the bank is subordinate and not going to disturb that income stream, that's all really good stuff to have and can make the paper more valuable. So yeah, I mean, that was a good deal for me, because I bought it in 2009 when there was no liquidity in the market, with a very motivated seller, and I was able to do the deal when the tower companies I worked at, there was two of them that both signed the deal. They couldn't close on it, and I went to the guy. I was very young, and I had a little bit of money that I made, and I'm like, hey man, here's my entire net worth. I'm like, I'll give you most of it. Give me the cell tower. He's like, let me think about it. He comes back. He's like, okay. He's like, we got a deal. And so I signed it up, and I closed all cash in 30 days, and I took the lease, and I just started working at Marcus at the time, and like I was burning money at the time.
Yeah.
Like, my net worth, like being a broker, just going down and down, and all of a sudden I had a Verizon lease in my pocket that I knew was worth more. It was worth more than I paid for it. Mm-hmm. And I was collecting $2,000 a month, which is like half my cost of living at the time.
That's awesome.
And it was the first time that I actually understood what owning an asset is, and the first time I understood like cash flow on like assets and net worth as well, like the cash flow component. So, I mean, that deal really changed my life in a lot of ways. And yeah, then fast forward, and it bought us the house at Brownstone,
During COVID.
I probably could have never have afforded otherwise.
Well, you got a top of the market price during COVID because they
For the cell tower.
Yeah, because they were looking at that, I guess, for some reason. Then you got a Brownstone for below market because it was COVID. So
And then I got really good finance.
Arbitrage.
It was just
Yeah.
they gave him like a full price during like a pandemic.
That's pretty. No, like
And like closed quick.
I'm not like a cell tower expert, but I did know like right tenant, right location, and then like sort of that the lease was well below market, and so a company that like the one we sold it to was going to ascribe more value to it because they could just bump it up. And so we bought down our basis by like almost $1.5 million on the deal, and so
Wow, it's insane.
we're closing
That is
into
nearing-
a very, very favorable basis for the whole portfolio.
Yeah, it's not like we sell the cell tower and then get reimbursed the money. Like the cell tower company literally pays for the portion of our purchase price.
Did you go
That's simultaneously.
Oh, you simultaneous. So you went to a closing table.
So we had to
sell
come
our
out.
company.
It was a $10.7 million deal, and we only had to come up with $9.4 million.
So they came and closing table with you. It all closed simultaneous.
Yep.
It's great.
Yep.
That's the way to do it. Yeah, we always talked about this. We haven't seen it done.
What, the Sollevare stuff?
Well, the simultaneous close. We're like,
It's much easier when you're doing it in cash than dealing with the bank. For sure. So,
well, I'll tell you, like, even like a lot of people that we all know mutually, like a lot of people don't know these things are so liquid.
They don't know. Everyone does.
Well, we just like
It's getting
you sold two for.
I was doing this in 2000.
No, I know, but how many people do we know that own these places with cell towers that are just recently you sold a couple for someone, right? Like in the last 3 years,
people
sold
don't really know. Like the people we were
surprised, man.
Yeah, competing with did not subscribe to really any value to that cell tower.
No.
Yeah.
They don't underwrite it. Like, but they underwrite it poorly. They
underwrite it.
It's worse than a horse. They can cancel at any time.
Yeah, that deal we bought pretty off market too.
Yeah.
It's relationships. And so like what we did wasn't like genius. It was just there wasn't that many eyes on the deal either. So we were able to execute.
Yeah, and you guys are all cash.
You all cash and
completely different. Do you guys ever go to the owners and like, hey, like we're all cash, like we'll close in 30 days? Like, do you use that as a competitive advantage?
Of course. I mean, to be crazy not to. I've worked.
Yeah.
We've seen deals where
we're pretty scrappy.
Yeah.
Like I was a broker. Like that's my game. I like that.
Yeah.
I know how to wine and dine a seller and get a good deal done.
Yeah.
Nice.
Yeah,
for sure.
And Jake is very naturally talented at that too. We play off each other very well in any of those scenarios. Like 4 deals that we've done, we've wined and dined. Like,
So the 4 deals you've done, right? We're talking about like the statutorily free market, and you're building these for like families, but they've also all been mixed use, right?
Not all. You wasn't.
Not all.
Yeah.
Okay.
I mean, we've done deals before we started Sollevare too, but
okay. Well, the ones that I was looking at recently, they all seemed like they're mixed use. So I'm wondering, like, we haven't talked about the retail component.
Yeah, it's a great point.
Or what you guys think in terms of that.
We had a little bit of an inflection point actually yesterday, where we're looking at a deal close by to where we recently bought, and 67% of the income comes from the retail. We love the asset, and then we're like, is this? And we're like, we're actively bidding on the asset, and we're like a few $100,000 away probably from getting the deal. And it's like, is this a Sollevare asset, and does this fit into our overall investment thesis? Mm. And we just took a step back for a second, and Jake is like, I don't think that this is a perfect fit for our thesis. I think it's very easy to start to shy away from like what we have so much conviction over. And so we're like, I don't think it is, and we don't think it is. So like, we're just not going to be aggressive on that. Like, we want the residential component for the thesis that we say, and the retail we're also very bullish on just because it services so much of Brownstone's residential neighborhood corridors, and like there's a lot of new product coming up in Gowanus, and what we love aspect of it being retail also for diversification purposes. We're very focused on the resi.
Yeah, I mean we are extremely bullish on the retail. So the deal we closed 2 weeks ago, there's also a retail component on each property, but it's like that retail is ultra prime, and that's where it is. Can we say street name or where it is in Carroll Gardens? Like
we don't know the street, but
it's only getting better. Like there's
for sure
that retail corridor is like 100%. In our opinion the second best retail artery in all Brooklyn outside of Williamsburg. Mm-hmm. And so like we think the retail is a plus, but
huge plus.
To when we think about our thesis, it's built around the residential demand that we see flooding into these neighborhoods, which will then also lift the retail.
It feeds the retail.
Do you think there's any discount to resi above retail in that area, like aside from like being on a side street?
When you say discount, do you mean like the type of rents that we can get?
Yeah, right. Like would they I personally would not care, and I know the truth because I've seen a million rent rolls that there really isn't that big of a discount at all. But it does surprise me because I would personally want to be on a quiet street versus on a retail corridor. But again, I've seen enough rent rolls to prove that I'm wrong.
When you're buying, probably yes. Yeah. When you're renting, absolutely not, especially when we're talking about Court Street.
Yeah. I will say yes. You're on
there it is.
It's not like First Ave in the East Village where
it's down.
It's crazy. It's like we're down there at 6, 7 p.m. sometimes.
It's so quiet.
We also, so many people in our industry also live in those markets that I always pick their brains about like, oh, would you buy a condo on like Court Street, or would you prefer, like, how much would you discount it? Because it's also nuanced. It's just
How
based on
much
someone's-
thing, yeah, for sure.
But yeah, and like most people say, if it's Court Street, no, like there's no difference for me.
And that's also
What about Smith Street?
I think Smith Street
this year.
is a little bit different than Court Street is, and that takes a long time to of knowing those
What
markets.
about like Flatbush Avenue or Vanderbilt or?
Definitely a difference.
Okay.
Yeah.
Vanderbilt, I'll give you a little bit, but Flatbush, no way.
Like Smith Street,
no way.
Smith Street, this is something interesting that a very large owner in the neighborhood kind of taught me. Smith Street is a price point retail block. And so there's only a certain price point that retailers can pay to run a successful business. Whereas Court Street is a price per foot block because it's just a little bit of a difference, but there's more foot traffic and it's a better retail block. Whereas there's no price point that retailers can't pay, so they go off price per foot. And so it's a huge difference in the retail.
Yeah.
From block to block.
Quick question, and obviously we saw a lot of this stuff, but are you guys, obviously you're doing renovations, right? But you mentioned the tariff stuff a lot. Are you like doing what type of renovations are you willing to do? Are you doing full guts?
Full guts.
Yeah,
Full guts, okay.
The deal we did in January, we were finishing up a full gut renovation.
Got it. So we show you deal with no floors, doesn't really matter, right?
Doesn't matter to us. We're gutting it anyway, in all likelihood.
Obviously the construction aspect of owning this stuff is tough and there's a lot of BS with it, but
That's something that's way easier than what we both initially thought it would be.
Really?
We don't have that much construction experience.
Yeah.
And I mean, very smooth so far. We use our connections to be introduced to the right GCs in the business, and like we really vetted out our GCs.
The right team is so
and so we have the right team in place also to scale.
A big part of what I think we've done well so far and what we are going to continue to do well, and one thing we both realized early on about each other is like we know what we know, and then we're also very open to knowing, like admitting where we don't know anything. And so like construction for me was certainly a weak point. Like he knew a little bit more. I was at Blackstone and Artemis before, which I learned a ton, but you're behind a computer. And so what we've done with the renovations and also in a lot of other aspects of our business is like being extremely careful with who we work with, because we know that we're going to be reliant on that person because we just have weak points.
We're learning.
And so that's something we've been good at, and what we did well with so far with our renovation scope is like being extremely selective on who we'll work with, but once we find the right team, like just relying on their expertise and
double checking everything as we go. So like just making sure that the materials that are being sourced at the right prices, and if we think something's overpriced, we're just double checking every aspect of it. So we're value engineering everything, and not to compliment ourselves too much, but we're very thoughtful about every single aspect of our business, from like our logo to how we're doing the construction to like the tiling that we're picking out to obviously what we're buying.
No, we don't want like cookie cutter rental product. We want it to have like, because these neighborhoods we're buying, there's such charm, and the buildings we're buying, they're all unique. And so we want to maintain that with our layouts and our finishes. We don't just want to like cut and paste at each building like some sponsors have done. We want
people would call us crazy, but we hired an interior designer to do a rental. Because we think it'll pay for itself.
And someone we know, we trust her, and she's all right.
It's big.
Yeah, I think it's a good move. I mean, we did that with some of our first projects.
We did
when we first started doing.
More expensive than I thought it was going to be, but yeah, no, it worked. It definitely gave some aspects. I mean, we exited that building for a ton of money, and I think there were some things in there. The rusty door, right? The rusty metal door was very nice.
Yeah, that was good.
Cast iron door.
Yeah,
it was very nice.
Luckily, our interior designer is starting to grow, and like she's in a similar position to us, so she's doing it at a discounted rate also to like grow and get more business. But her name's Morgan Baker, and like she's unbelievable.
All right, good.
Yeah,
sweet.
All right, cool, great.
Yeah, I mean, this is good stuff. We're rounding the corner on an hour here. I think this really. Yeah, it's bye. But no, I thought this conversation was great. I think we learned a lot. I mean, I could have dug in more. I think in terms of
we're good.
Well, hang on, just wrapping up.
All right.
I think we could have dug more maybe on like the Marcus and Newmark stuff. But honestly, I don't even think it's relative compared to this conversation. So Yeah, all in all, I think it was really good. I'm not sure if there's anything else you guys would like to go over.
The only thing that I will say is we touched on this a little bit, how like rent regulation is good for, I guess, people who own free market buildings. But something that isn't really talked about is I think it's extremely exclusionary. To like, if you're young and you want to move to New York City, like everyone at some point moved to New York City, rent regulation allows people to stay in place and never move. And like, what happens if you're young now and you want to move to New York City? Like, there's no housing stock. And so like,
For sure.
I don't think that's talked enough about in like the political landscape of how exclusionary those laws are to anyone who wants to come to New York City.
Yeah, and they're vacant. A lot of these stabilized units are vacant.
There needs to be
100,000
something.
units, I heard. Something crazy.
There needs to be something that changes, but that's all. Yeah, it's all the same thing.
I'm making it apart. People are still skeptical. I mean, people are definitely making some bets on the stabilized stuff and trying to get something in the portfolio, but there's not a single thing that makes sense about it from any aspect you look at. From a tenant
there's some
perspective,
things that make sense.
Well,
They don't want people being pushed out.
You know, there has to be some form of rent stabilization,
Yeah.
but it's just the way that the laws are right now are so exclusionary.
Yeah,
It
100%.
limits all the supply in New York City and doesn't allow any turnover to happen. And then the little bit of turnover, or like the small percentage of free market units that are in New York City, I think it's only 58% of the housing stock in New York City is free market, is that much more expensive because half of the housing stock never, ever turns over.
What are people doing? What are people that are graduating from college? What are they doing?
They just
not moving here?
They can barely afford it. Like, it's just ridiculous that the city doesn't allow there to be more housing constructed, and there's just not better laws. But
now you
this
have
is a rabbit hole.
you have even the regulation on the free market units, which is going to make people not leave those units.
Good point.
Exactly.
And then the stabilized. So now you're getting like the double whammy. So you got
So how can new people move into New York City, and like, why is that more fair than saying that someone is more entitled to be here?
You flip the coin now a little bit here, and I like it.
That needs to be talked about more.
Yeah,
It's not fair.
Talked about. I agree.
Yeah.
for sure. Good point.
If you don't come from an affluent family, like, how can you move to New York City?
You actually can't.
Even if it's not
That is so ridiculous.
You don't come from an affluent family and don't get like a high paying starting salary job like in finance, I don't know how you move here. Like you kind of can't.
It's terrible.
Yeah.
It was hard enough when I moved to the city in 2012. I can't imagine. I don't know how people are graduating college now, aside from getting a job. They have to get a job, obviously, but the money is the first job. There's not enough money in it to like support a New York City lifestyle within the reason, and like get an apartment.
Yeah,
I wasn't able. So I was fortunate. I moved here. I had a good job when I moved here, but I wasn't. So like I paid my way here, but if I didn't get that job, like I don't know.
Yeah.
Where I was starting, if I had started with that salary and everything, even adjusted to New York City standards, I don't know if I would have been able to like live here. I guess I don't know.
We see it all the time. People talk about it when they're looking at apps. I mean, people are spending like 90% of their income on rent. And so, and it's probably 100, and everything else is going on credit cards.
Yeah,
it's probably what's going on.
Yeah,
but it's
I moved here without a job. Just moved here, wanted to be in the city, wanted to see like where my career would go here, and like I was able to take that risk. That was in 2005. And you're right. Like if it was today and I was graduating college, from Colorado, would I just move to New York and try my luck and like try to figure it out? And I don't know that you're able to at this point. So that's really unfortunate. And it does have to do with
sometimes
with the laws. Yeah. And that also impacts, I guess the pipeline of people that are going to be moving to these neighborhoods and the tenant base for the future as well. I mean, New York's obviously really resilient. People are drawn to it, but that's I guess what I'm wondering is where are all the young people? Are they coming here still?
Yeah, I think they are.
A lot of outer boroughs stuff too, like we
outer boroughs.
kind of discussed.
Mm-hmm.
But I don't know.
Yeah, it's nuts.
Yeah.
All right, guys. Well, this was a pleasure.
Yeah, we appreciate you guys
for sure.
Thanks so much.
Congrats on everything you guys have done.
Thank you.
And good luck with everything going forward.
Thank you.
Sure.
Yeah, no, thank you for having us in here. This was awesome.
All right, cool.
Very cool.